here from Creativo Solutions. You're currently watching the Finance for Non-Financial Managers video series. If you have any comments or questions, please feel free to post them below, and if you subscribe to this channel, you'll be the first to find out when new videos are uploaded. Please visit the website to find more content and resources to help you. We are also on Instagram and Twitter. Please consider following us on those platforms and keep watching the YouTube channel for more support. We've covered several topics already, looking at different areas in finance. We've just covered a section dealing with risk, and we now know that risk is uncertainty. We know there's a linear relationship between risk and return, meaning if there's more risk, we would expect a higher return. It's almost like a cost versus benefit type analysis where we're looking at taking on risk so long as it maximizes return. We are now going to be considering finance and economics, and we're considering the link between these two subjects. We know that finance is a discipline that can be studied on its own, and the same goes with economics. It's also a discipline where you can actually study it, you can delve a bit deeper in the actual theory relating to both of these different topics. But are these two linked? Well, yes, they are. So we've established that decision making is going to focus on maximizing value. We know value is key, and if we're creating value, then the business should become profitable over time. We know that a business is going to have to make decisions, and they need to weigh up the risk versus the return. The risk would be the uncertainty around a specific decision. So if I do something, what is the expected return going to be? Is the return going to be positive or negative? Well, we'll have an expectation. If we're comfortable with the risk, we'll then make the decision and we'll go forward with that particular decision that we've made. So have a look at all these different concepts that we've got here. We've got inflation, debt, bankruptcy, money, unemployment, prices. There's such a lot of different concepts here that relate to economics. So if we're talking about inflation, is inflation a concept that's going to affect the decision making when it comes to taking those limited resources, which we know is generally in the form of finance, and allocating that resource to a specific product or investment or asset, depending on what we're trying to achieve? Inflation, we know, is the gradual increase in prices over time, or the reduction in buying power. So if we're looking at inflation, is that going to affect decision making? Well, the answer is definitely yes, because that would add to the risk part of the actual discussion, because inflation would be something that we would have to provide for as a cost that we need to actually provide for in the actual decision making. Other things that we could consider is maybe debt. The level of debt, is that going to affect our decision making? Well, definitely. Debt again would affect our decision with regard to how much resources we're going to be committing to a specific product, maybe a project, or even an investment. Before taking on a new project, we're going to have to consider, well, how heavily indebted is the business? If the business has a lot of debt, there could be a high risk of bankruptcy, and that'll definitely affect decision making. Could something like unemployment affect decision making? Well, again, the answer is yes. If the business is going to be making decisions and there's a high level of unemployment, either within a specific, let's say, geographic location, okay, or as a country as a whole, that'll obviously affect decision making in certain areas. So these are all different topics that we need to be mindful of, because these topics will affect the risk and possibly the return. So we've established that debt and inflation and bankruptcy and unemployment are all negative things that we need to consider that will obviously affect the decision making around the risk. We could also consider the return. Well, if inflation is very high, we would expect the return to be affected by that, and therefore we might not receive as much in real terms in the future if we're going to be deriving some sort of benefit in the future, but there's a high level of inflation. So both concepts need to be emphasized, and we need to consider the impact that economics will have on both of these concepts, the risk and the return. In financial management, we know that decision making is everything. We're making decisions to maximize value. So financial management is definitely going to be affected by the different economic developments in the market, and by having more information, that's definitely going to allow us to make better decisions. And with more information comes more insight as to what is actually happening in the market. And if we do have that understanding and we have that information available, we can make better decisions. So now we have a better idea of the relationship between finance and economics. Something else to consider is when looking at the market, the financial markets transition through different economic cycles. So we're not going to have one specific phase in the market, be it expansion, boom, recession, or even depression. So in the market is obviously driven by supply and demand. We know that supply and demand is theory that comes from economics, and the supply and demand would then affect the market's phase. In other words, we could be in a growth phase perhaps, where there's lots of expansion and even boom, or perhaps there might be a recession or even a depression where the economy as a whole isn't doing very well. We know that countries experience different cycles, and not all countries will be in the same economic cycle. Different countries could be in different economic cycles depending on their current position. What will remain constant though is that the market will cycle. There'll be good times and there'll be bad times, and we need to try and make the best decisions in that specific cycle. Why is that important? Well, we know that businesses are going to be making decisions based on what's happening in the market. So if we're looking at these cycles, how would it affect the decision making? Well, if we're considering a company that's operating in a good economic cycle, well then we would expect that sort of company to maybe take on more risk. So they might be willing to invest more, or they might be willing to expand into different areas, or even launch new products. But if the economic cycle is in a bad position, maybe a recession or even worse, a depression, well then the business isn't going to be so keen to taking on more risk because the market is more negative, and sentiment generally in the market wouldn't be as positive. So depending on the business's strategy, it might be an opportunity to invest in a recessionary type environment because you may be able to buy assets that are either underpriced or cheap in relation to the rest of the market. So there could be pros and cons to all of these different economic cycles. We need to understand and identify what cycle is the market currently in and what cycle we would expect the market to move into, because that gives you a little bit of insight as to what could happen in the future. And we know knowledge is really important when it comes to decision making. So always remember that finance and economics are linked. Having a good background in economics will definitely help you with decision making that relates to finance, because one will affect the other. Having awareness of the market is key when making decisions. That takes us to the end of this video. Thank you for watching, and please subscribe to the channel and comment below. And if you do like the video, please hit the thumbs up button, and we'll keep making the videos to help you.